What's up, everybody? So we are doing a new segment on the podcast, and by the time this airs, I won't have figured out a name for it yet. I'm going to try to find some type of catchy name, dissect the deal, behind the closing statement. I don't know, some type of name that describes what we're going to talk about with some guests here in the future, which is let's dive into a deal that's got some hair on it, that's got some backstory to it. I always find that these types of conversations are well received by the listeners in terms of like actually talking about a deal, because it takes everything that we talk about and makes it tactical. And that's what we're going to do here with Sean. So if you haven't listened to the actual interview, that went up on Tuesday. Go back and listen to it. It was a great conversation. But in this episode, which will probably run 15 minutes or so, we're going to dive into a deal. So first things first, Sean, let's describe the property. You know, we're talking size, market, type of real estate, and then we'll get into it from there.
Got it. Yeah, so this is a unique one. This is a portfolio deal. It was 23 total units, 3 properties in the portfolio. We had a 5-unit, a 7-unit, and an 11-unit to make up the 23. And these were classic New England multifamily, so 1900s built, staircases up both sides, nothing fancy at all, downtown locations in Manchester, New Hampshire for 2 of the properties, and then we had one out on its own in a smaller city in New Hampshire called Farmington.
Love it. And how did you find this deal?
This deal was off-market, total network deal. So this was a owner who had a 91-unit portfolio, which ultimately we ended up purchasing the whole portfolio staggered over the course of 3 different deals. This was the first purchase of that portfolio. And it was brought to me by a residential agent who was a personal friend of the owner. And the owner had bought the properties for cheap. It was kind of an afterthought to him. He had a regular full-time business that was throwing off lots of cash, and they had fallen into a slight state of disrepair. You know, not a lot of attention being given to CapEx or interiors or really anything, and he was just kind of ready to sell. So it was a great situation. I was really the only person in that realtor's network, I think, who had any experience with deals of that size, and it just kind of fell in my lap on that front.
Yeah, I mean, as an aside, that's a story that we love is commercial real estate deal, residential agent, limited network of buyers who could take on something like that.
Right. And
usually there's a story with the ownership as to why the deal may be compelling to pursue, because they're maybe hiring the wrong person for the job, so to speak. So let's talk about, let's get into the numbers. What price did you pay for this deal?
Okay, total price on the 23 units was $2,050,000.
And 23 units, so we're talking under $100,000 a door. And then I forgot to ask too, this was 2022, I believe, right? Or 21?
End of 22.
End of 22.
Yeah.
So even end of 22 in New Hampshire, sub $100,000 a door was
those
deals were hard to come by.
Yeah, but rough condition, rough tenant base, high vacancy situation. So these were not turnkey by any means.
How did you capitalize it? So equity, debt, anything unique there?
Yeah, we did a local bank loan, and in terms of capitalizing down payment or equity into the deal, at that point in my career, $2 million was about the ceiling of deal size that I had participated with in the past. So I ended up contacting you, actually, because I had been watching you buying deals of that size for the last couple of years. And we ended up forming a joint venture where I brought in a couple investors, you brought in a couple of investors, and we did a joint venture deal and took the deal down that way with local bank debt, I believe 25% down. And I think we had a renovation budget in the area of $350,000.
Yep.
Financed at closing.
Yeah, that was a perfect example of like you get a few people together on a deal that, I forget how much total capital is needed. It was like
total capital invested was $555,000.
Perfect. Yeah, you got it. You can write your fingertips here.
Yeah.
But like that's like the perfect amount for like a small group of individuals to get involved and put together like a very simple deal structure, which is good on a deal like that. Let's talk about the business plan. Renovations, any kind of specific management challenges that you remember, like with those 3 buildings, anything that sticks out?
Yeah, definitely. I mean, it was a bear of a project, no question about it. The two Manchester properties are not in the best areas, and it were half full, and the people who were there were not paying. So I was a classic rough value add takeover, right? We had to get in there. We had to assess the situation on who can stay and who has to go. And then we were looking to move through renovations very quickly. That was essentially, let's renovate all the vacants first. Let's assess the inherited tenants for reliability and then make moves there. And that was the business plan. I believe we had 4 or 5 vacants on takeover. So obviously we jumped right on those. And then from there, we started addressing legacy tenants.
Yep. Yeah. What went better than expected post-closing?
I would say the rents we were able to achieve in downtown Manchester, I think we were pro-forming 18 something for 3 beds, ended up getting 2,100. So we overperformed in Manchester and was able to hit numbers that we didn't think were possible on a fully renovated downtown unit. So I think that went really well.
Yeah, and I think if you're, that's the biggest thing underwriting-wise too, as an aside. It's if you're outperforming your projected rents, so much of the rest starts to take care of itself.
Of course. Revenue fixes all problems.
It does. In multifamily, it's your rents are driving 80% of your results at the end of the day because, your expenses are fixed.
And it just speaks to a smaller multifamily. Part of the reason why I love these 5s and 6s is you can be so nimble and so quick. So we have a 5 and a 7, and we're able to, in the matter of 6 months, get all the vacants renovated, get all the bad apples out, start renovations on the rest. You can move through a business plan on a small property like that very quickly, and we were able to do that especially on those Manchester properties.
Mm-hmm. Yeah. What went worse than expected post-closing?
Well, I think quickly we realized that the Farmington property was the bad apple here. I think that was kind of the reason we got such a good deal on the other 2 is because we had to take the Farmington one along with it. It was kind of just tagged on there. So we renovated quickly there, same as we did in Manchester. Nice units, came out great. Very quickly ran into leasing issues, getting the numbers that we wanted. Ended up realizing the tenant base in Farmington wasn't exactly really what we wanted. The property itself, from a bricks and sticks standpoint, not something I would want to own long term. Dirt basement that flooded constantly, split utilities across the units, kind of all the nightmares that you deal with old New England real estate. This property had it. So I think it was a month in, I was telling you, I'm we got to get rid of this thing. So we knew we did a great job with turning it around and we got the numbers looking pretty good, but I knew right away this was not something I wanted to own or manage long term. And ultimately it ended up being a positive for the business plan.
I think that was I remember the word coming to mind when we were talking about the building. I was this is just a bootlegged building. It's just one of those things where, you had Uncle Joe going in there and replacing an electric panel and sending the wires.
Totally.
And it's you can catch a lot of that stuff during due diligence. And, we knew we were getting into a bit of a stickier building, but it was the price is so compelling. We have a lot of room to absorb some, chicanery here.
Yeah.
But even still,
but I think we thought going in we're going to keep all 3. We're going to keep all 3 and keep the portfolio together. And I think very quickly it kind of shifted towards maybe we can just get rid of this one, because it's causing some headaches.
Exactly.
Yeah.
What was the end result?
End result. So we ended up selling off that 11 unit after 1 year of ownership, after turning it around over 1 year. So just to recap, bought all 3 buildings. $2,050,000 in total capital invested was $550,000. We sold the 11 unit off by itself for $1.21 after 1 year of ownership, and our proceeds, after we kind of worked out our partial mortgage payoff and everything like that, our true proceeds at the table were $505,337. So almost got all of our initial capital out with just that one building being sold.
Yeah, but the definition of a home run outcome.
Totally.
If you can take all of your, call it, chips off the table, and you still own these 2 buildings that are, we hadn't completely renovated both of them by that time yet, but majority had renovated.
Right.
That were, stabilized.
Great market.
Stabilized, good locations, within Manchester in terms of we had parking, we had all the stuff that you really want. Mm-hmm. And you don't have any money into them, and you've got reasonable LTV debt, that's a home run outcome for sure.
Totally.
And you didn't have to send your guys up to Farmington anymore.
Yes, exactly. And then we continued the home run by ultimately, refinancing those remaining 2 buildings and got an additional proceeds at the table of $242,000. So totally, we all in all, $555,000 invested, $748,000 pulled. Still own the 12, which are performing fantastic in good locations of Manchester with solid long-term debt. So
yeah, which is exactly what I hope for.
Yeah.
Biggest lesson or takeaway from the deal, either positive, or negative?
Yeah, the lesson is I love portfolio deals. I love the flexibility that comes with a scattered site portfolio. As long as you can, put the right financing on it up front. I think one of the big things we did up front was making sure the lender was okay with a partial release.
Yep.
If we were to sell one of the properties in the portfolio off, which worked out very well for us. But the lesson for me was embrace the scattered site portfolio that everyone's afraid of, because It's a lot of work to manage. That's kind of a barrier of entry, but it gives you these flexible exits where we sell one, we sell two, we keep this one. And I think that's a great position to be in as an operator, just to kind of have those options available to you. So it kind of sold me on portfolios, even if they're scattered all over the place. Having multiple deals under one purchase, I think, makes a lot of sense.
100%. Yeah. I mean, like, so much of like our business, like within Aligned, and I know you guys have bought a number of portfolios too, but is like the older owner who bought, 30 units over 10 years, and it's 8 buildings, and now they want to retire. They just want to sell them all. And it's a great position to be in. Yes, there's a little bit more complexity because you have the partial release dynamics of a loan, which, like, the real actionable tip here is, like, if you're going to do a portfolio loan, like, get into the partial release language. Like, we've done some where the language is not very borrower friendly, and it's like, whatever you're selling one for, you got to use all those proceeds to, like, pay down the loan.
You don't touch a dollar until everything's paid off.
You're not getting anything at the closing of that first one, and next thing you know, you got to sell one and then refi the rest to get, and that's like a pain in the ass. But if you have good partial release language and you can take chips off the table along the way, and you're looking at a deal where you're buying all of these at one, call it average per unit price, there's probably going to be some that you're getting a good price on. Some you might be paying a little bit more than maybe what they're worth, right? Just, I'm speaking broadly, but go ahead and create a ton of value with the ones that you're getting the really good deals on. Sell those, and then you're pulling a lot of your dough off the table.
And it's the amount of work and effort that goes into managing a scattered site, which I know you're familiar with through Blue Door, that creates the opportunity to get a good deal, right? So, because that guy's so stressed with his 15 buildings that are all spread out, that's why you're going to get a smoking deal versus the one guy who has the 100 unit and he's chilling. He can sell for whatever he wants to, So
100%.
Portfolios, I've been totally sold on. I think that's one of the last areas of opportunity to really get smoking deals on the front end. So,
and there's a ton of them out there because we got a lot of folks in their late 60s, early 70s, whatever, who are retiring and they just want to sell all of it, right? Because it's like managing 6, 7, 10, 3, whatever individual transactions with with a broker, walking people through is like a ton of friction for the seller. So you get the double whammy of they might be interested in, like, okay, I know maybe if I sold each individually, I could get another couple grand a unit more. But like, that's a ton of pain in the ass on my end. I'd rather just sell them all. And then the other piece of it is you as a buyer, depending on the size of the portfolio, may actually get better financing terms. You may get a slightly lower interest rate because it's a bigger loan. You maybe got a little bit more negotiating power with the bank or whoever it is. So you kind of, you're getting 2 different benefits there as well.
And the big boys, they're just not chasing those deals as much because of the management intensive aspect.
Exactly. Yeah. Awesome, man. Well, if anybody wants to get in touch with you, we shared your contact info at the end of the last episode. So again, if you haven't listened to that, go back and listen to it. And if you want to, reach out to Sean and learn more about what he's got going on, it's going to be in the show notes and then at the end of that episode. But I think people are going to enjoy this, and appreciate you running through and taking some notes too, because I think that makes this really actionable.
Yeah, happy to be here. Thank you, man.
Awesome.